Hello everyone, thanks for coming, and today I'm going to review the keynote for week 2's lectures. So we have the strike price, we also have the spot price. Usually we denote S0 to be the spot price of the underlying asset right now, but it is irrelevant of the payoff of the option. We have the ST, which is the spot price of the underlying assets in the future. T, which is used to calculate the payoff for an option. We have K. K is a strike price. So if it is a call option, then we have the right to buy the underlying asset at the price K in the future if we hold the call option. If it is a put option, then we have the right to sell the asset at the price K in the future. So S0 is not used to calculate the payoff for the option. So what we should pay attention to is the net profit for options. So it is different from the payoff because we need to calculate the premium as we introduced last week. So we have the maturity, we have the strike price, we have the premium C0 for a call option and the P0 for a put option. For call option, the net profit is ST minus K plus minus S0. If we buy the underlying stock directly, the payoff is ST minus K. So the first term ST minus K plus means that if the price is lower than K, then we will not exercise the call option and the net profit will be minus 0. So for put option, the net profit is K minus ST plus minus P0. So this means that if the price is higher than K, then the put option will not be exercised and the cost will be P0. Note when the options will not be exercised for the call option and for the put option. That's what we should pay attention to. So there are some differences between future contract and forward contract. First, future contract requires daily settlement, which means that the loss and gain will be calculated daily in our account. We also need to pay an initial margin for if we set up a future contract. For the forward contract, typically we don't need to pay anything. So we need to deposit a small amount of initial margin in our account if we enter into a long or short position in the futures market. We also need to ensure that the remaining balance in our account is always larger than the maintenance margin, or we will receive margin call to ask us to provide additional fund to our account. So what is important about the daily settlement is that if we make a profit, we can withdraw the profit, but we still need to ensure that if we withdraw the profit, the remaining balance is not smaller than the initial margin. It's always above or equal to the initial margin. At any time, we must ensure that the margin is above the maintenance margin. So that means if we make a profit, we can withdraw the money, but we can only withdraw the money above the initial margin. If we suffer from a loss, perhaps we don't need to deposit into our account immediately. Only after the remaining balance is below the maintenance margin, then we will be asked to provide additional fund into our account. So then we introduce the term of hedge. What is hedge? It is different from arbitrage, which is to make free money, or different from speculate, which means to bet on the future trend. Hedge simply means to take the action to reduce the risk. For short hedge, it happens when one wants to sell something in the future. So he takes a short position in the futures market or in the forward contract. he could lock in the price right now. For the long hedge, one wants to buy something in the future, so he could take a long position in the futures market or in the forward contract, and he could lock in the price. Thanks for listening.